Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. And on these FastGraphs YouTube channel, I'm always talking about valuation. I'm often providing research candidates, companies that I think are worthy of further research and due diligence. And in conjunction with that, I'm also talking about the importance of research and due diligence. And, I also like to point out things like diversification is, I believe less is more with things like diversification, because I believe it's very, very important that you know as much as you can about the investments that you're making. And again, that really is ultimately the goal of comprehensive research and due diligence. Well, interestingly, we're going to be launching our new version of FastGraphs hopefully by the end of this month. Our guys are working really hard. We're getting really close. I've been playing around with it when it's functioning, and when they give me windows where I can use it. And I'll tell you, it's really going to be worth waiting for. But having said that, the whole purpose of the fundamentals analyzer software tool FastGraphs is to be able to empower investors to research stocks deeper, faster, more effectively, and more efficiently. As I say here in my sign over here, that researching stocks has really never been easier if you have FastGraphs. So we're really going to try to meet that promise, if you will, with our new tool. But about 2 years ago, I had a subscriber actually request, it was February of 2019 to be precise, request that I, talk more. I'm always talking about the importance of research and due diligence, but, could I do a video and show how research and due diligence is conducted? Now, I did that video, and what I'm going to do here today is something a little different. I'm going to show about 4 minutes of that video that I recorded back in February of 2019, and then I'm going to update it to current, if you will, and kind of go through the research and due diligence process. But in addition to just continuing to talk about how I conduct research and due diligence, there's some other lessons in valuation here. Keep in mind, this video was produced just before COVID hit. Okay, and COVID obviously threw a monkey wrench into the process. But yet, what I believe this video and this updated video is going to illustrate is really the importance of comprehensive research and due diligence, and how it really can effectively serve the investor when it's done properly and correctly. So let me start by going ahead and going into this old video here that was produced on February 11th, 2019, and run about 4 minutes of it for you. So sit back and watch, if you will. Subscriber to my YouTube channel asked me if I could do a video on how I go ahead and conduct due diligence. The viewer said he really liked the content, and I'm always suggesting that and recommending, which I do recommend, that the viewer conducts their own comprehensive research and due diligence before they invest in any stock. And I'm just trying to point out what I like to call research candidates. So what I'm going to do with this video is kind of go through the process that I would utilize to conduct my own comprehensive due diligence and research on any stock that I might eventually be interested in buying. Now, the process starts by taking a quick review of what I'll call the basic FastGraphs. First thing I'm looking for, and I'm going to use in my example for this video, Snap-on Inc., the tools and hardware manufacturer and marketer. And the idea here is I'm looking for, personally in my own strategy, I'm looking for a specific kind of company. I'm looking for a company that has a consistent operating history. And if I'm investing for dividends, and in this particular example, this is a dividend paying stock, I'm also looking for consistency of the dividends. So I start out by looking at the fundamentals. This white line is the dividends per share, and then this orange line is earnings per share. Now you can see that we had one drop in earnings. Earnings fell by 43% during the Great Recession, but I also want you to note that the earnings recovered very nicely. So a little bit of recession issue there, but not really anything that I'd be totally alarmed by. If I go out to a longer term graph here and look at the last recession, we also see that they had some issues coming out of the last recession. So those are things that I would consider. But all in all, as I look at this stock, it looks like the kind of company I like. It's got a pretty good record of growth. Earnings growth since 2002 has averaged 11% a year, as you can see here in the Fast Facts box. And this is something else that I do. Once I start with a longer term graph, I tend to shorten the graph. And I want you to notice here that the earnings growth rate actually increased. If I shorten the time frame from 2006, I cut some more time off, and it's sitting around 15%. So what I'm seeing here is a reasonably consistent record of double-digit earnings growth. Got as high as 17%. The last, since 2014, it's been averaging 12%. So I've got a company here that I feel pretty comfortable is got a good record of growth. But then here's the thing. I like what I see so far. I like the dividend yield. I like the credit rating. And I like the fact that it only has 22% debt. So everything I'm doing at this point is to determine whether or not I believe the stock is worthy of my time and effort to go ahead and conduct a research. But it ultimately comes down to valuation. So here I bring monthly closing stock prices into the equation. Now, the company was the same company in 2015, for example, as it is today. The big difference being in 2015, it was dramatically overvalued. The orange line represents the earnings justified valuation line, and we can see the stock was trading significantly above that. And you can also see that with a lot of volatility in between, we really had no performance going on since, the high valuation of 2015. I can measure it here from peak to trough is what I'm doing here. We actually would have had a negative rate of return over approximately a 3-year period, but that was during a time frame when the earnings grew by 13%, 14, 10, 17. So the company did extremely well, but the stock did poorly, and that was valuation. Anytime you could have bought this stock when it was trading at or below the orange line, it would have been a good time to purchase it, notwithstanding the Great Recession. So this tells me now at this point, I've simply made the decision. I think this stock is worth taking a closer look at. So this is adjusted operating earnings per share, and I want to point out this is a dividend stock. All right, that's enough for the old video. If you really found that video interesting, you can go ahead and I'll put a link in the bottom here of this video where you can go back and watch that video in its entirety if you would like. But what I'd like to do now is go ahead and update. In that video, I go on and show how I go about research, how I look at the company's website and so on. I'm going to do that for you here in this video. But before I do that, I want to kind of get a perspective of what happened after that video was produced. The forecasting earnings for the next couple of years when I did that video were actually better than what they came out. But they were still within reason. Even COVID didn't destroy this company. As you recall, I pointed out in the video that the company had a very good balance sheet. It had a high quality rating, A- rated, only had 22% long-term debt to capital, and it was really a pretty strong company. And that's one of the real benefits of comprehensive research and due diligence. It can position you to make good decisions even when you're wrong. And of course, at that time, there was a modest margin of safety. The red dot here is approximately when that video was produced. It was produced on February 11th. This is February 28th. I believe the price in that video was about $153. But what I want to point out is that, the company did pretty well going in from, throughout the rest of 2019. But then, of course, the COVID pandemic came and we had the big flash crash. And then in 2020, we had a drop in earnings, which obviously precluded that. And of course, this was fear-based. This flash crash happened before the actual earnings began to falter. But then once COVID kind of passed, we saw this good, strong, healthy company recover again from an earnings perspective, and earnings began to grow again. And we're still under what the estimates were when I did the first video, but as you can see, we're starting to get some really good operating performance out of the company. And I do think it's important to mention that the dividend increased through the whole time that, since that video was produced, which was, about 2 years ago, a little more. And, here we are going into the future and they're still expecting good things to happen. But what's really interesting is what happened to the stock price. We had a margin of safety. We ran into a calamitous period, something, a 100-year event, something that was horrible. The stock did drop precipitously, obviously. We had this 32% drop in the value of the stock from February 2019 through March of 2020. So that was really a horrible year. But then from the recovery perspective, since it bottomed out in March of 2020, we've now had the stock rise over 100%. It more than doubled since then. But I also want to point out it's now become, moderately overvalued again. So today, I would not use this as a candidate for a stock that I would recommend today. Now, I would recommend it if I could get it with a margin of safety again. So I do want to make that clear, because when I go into the forecasting calculator, it is technically in the upper end of what I call fair value, which are these 5 orange lines on the forecasting calculator of a fast graph. So it's not like it's crazy overvalued, but it's certainly not inexpensive. And if it's still traded at the current PE ratio that it's trading at, you could still make double-digit returns. But if it reverted to the mean and fell down to the 15 PE ratio, our returns would be rather anemic. Now, long-term growth for this company is still expected to be almost double-digit, over 9.68%. So let's pretend that I'm doing this video when the stock is undervalued, because what I'm going to do here now is go on and reiterate, like I did in the first video, how I would go through the research and due diligence process. I wouldn't do it now on Snap-on because I think the stock is not worthy of my time and effort, because I think it's too overvalued. But if I was going to conduct research and due diligence, here's what I would do. And when we designed fast graphs to facilitate this process, I would go into the external links up here, and usually the first place that I go when I'm researching a stock is into the company's corporate website. Now, when I do that, I recognize that I'm going to go into a propaganda machine here. Obviously, the companies like to put their best brands forward, okay? But, you know, this company is a company that builds tools and so on for working on automobiles and things. It has some very interesting products here, as you can see. I'm just going to kind of go through this quickly, but I would go in here, I would learn about the company, I would go through, you know, their customers, who they work for, who they provide their services to. I would, you know, go in and learn about the company. I would look for any current news. I would look at their history, because you can learn a lot about the company's history and culture by, you know, going through the website. And again, always remembering that I'm looking at this with a somewhat jaundiced eye, recognizing that the company, I've never seen a company website yet that said, gee, we really have a lousy business here and our people are horrible and, you know, we really screw our customers and we're really a bad company. They're always going to try to put their best foot forward. But knowing that, going in there with my eyes open, I know that I can learn an awful lot about the company. I would also go into things like the investor services, where I would start looking at the financial information, the annual reports, the investor events, you know, even the investor kit, where I could learn things about the company from a standpoint of the company's perspective. Okay, I've got a fact sheet here, which I could look at. Now, this is current. This is not February of 2019. So I'm getting, you know, first quarter 2021 numbers. Since 1939, Snap-on has paid, you know, consecutive quarterly dividends. So I'm learning an awful lot about the company here just by going through some of this kind of information. I learn a little bit about their growth strategy, you know, what they plan to do to continue to grow their business and so on. So I'm evaluating what I'm learning on the company. But once I've done that, and I've spent some time, usually quite a bit of time, learning about the company, getting a feel for the business from the company's website, I like to turn to external sources. For example, one of my favorites is the Wall Street Journal. One of the things that I can do, besides just getting a quote, I can, you know, very quickly review any news that was recently out on the company. And here's an announcement that they're, you know, this was in April of last year, that they're going to present at the Oppenheimer Industrial. I could have found that conference on the company's website. I could also learn about who their competitors are, and I could even go in and look at some of their competitors to see how the company stacks up that way. What I'm trying to do here, I'm trying to learn as much about the company as I possibly can. Now, I also subscribe to my own research services. For example, I subscribe to Zacks, and I can go into Zacks and I can look at, you know, the research that they have. Their opinion is that they give it a hold, and that would obviously corroborate what my feelings are, because I do think, as I mentioned earlier, currently the stock's a little overvalued. But they do give it things like industry rank and so on, and they give me some, you know, basic data here. But then I've got this analyst report, and I can go into the analyst report, and there's a lot of information about the company. I get some information about the overview, the fact that it's headquartered in Kenosha, Wisconsin. It's a global provider of professional tools, equipment, and related solutions for technicians, vehicle service centers, original equipment manufacturers, and other industrial users, I kind of mentioned earlier. And I can learn more about their product. You know, their tool group is 40% of their revenues. Commercial industrial is 30%. Repair systems and information, another 30%. So I'm getting now into some of the nitty-gritty of the company. I can look at Zacks analyst reasons why they think the stock is a buy. And, you know, I can go through this and read it. But they also give me the other side, which I like. They give me the negative side, reasons I might want to sell, things that, you know, risks that I might take in investing in the company. So I would go through that research and look at it closely. I also subscribe to Morningstar. I would go in and do a Morningstar research report, and I would see what Morningstar, what they give their fair value, what the close is. And remember, fair value is not always, you know, exactly what I would think fair value is. Morningstar has their own way of doing that. But I can go in here and look at their fair value, and I can evaluate, they're increasing their fair value to 164 to reflect stronger end market performance. They expect sales growth of 5% over our 5-year forecast, with 11% rebound in 2021 after down years in 2020, etc. So, I can go through here and learn why they think they, put the numbers that they put on the company. But I've also got others, so I can go into Edgar and get into the company's actual finances. I can go to Google Finance. This is another source that I can access directly through FastGraphs. And I can, learn some more information about the company here on the, the Google site. In addition to a quote, the stock's up, 1.44% as I'm doing this video. I also have sites like Seeking Alpha that I can go into, in Yahoo. And I like Yahoo especially because where I usually go from, once I've kind of done this, and keep in mind, this is assuming that I like the business. I'm trying to just give it an update here for you from the previous video I did. I would go into the forecasting graph, and I would look at things like the analyst estimates, and I would look at, how many analysts are in the universe for the consensus. And then, like I always like to do, I would check to see how the estimates have been going. Now, the estimates have been improving. Okay, so that's kind of a really good sign here as we come out of COVID. Sentiment's getting a little, more positive on not only Snap-on, but really a lot of companies, I might point out. So I would be, looking at the forecasting data here, trying to figure out what was happening. But I would also corroborate that by going into Yahoo Finance here for my external links. So I've got earnings estimates of $13.35 for this fiscal year and $14.20 for next fiscal year. If I go into Yahoo estimates for 2021, I get $13.40 and $14.09. Now, that's not exactly what I have on FastGraphs getting S&P data. This data comes from Reuters, but it corroborates it. $13.35 versus $13.40 is, pretty close. $14.09 looking versus $14.20 are pretty close numbers. Now, they also will give me a 3 to 5 year growth rate. The FactSet data analysts, I've got 2 analysts giving me 9.68% growth. If I go here to Yahoo Finance, I've got 9.7% growth. Again, that corroborates what these guys are saying. It's even rounded. It's probably the exact same number. So, I like that. Now, I also then check the analyst scorecard. This is, again, part of my research process. And this company has almost an impeccable analyst scorecard. They only had a problem in 2009, which I alluded to earlier when I said their earnings were down. That was the Great Recession, of course. And that was when the analysts were making a forecast 1 year in advance. When they were making an estimate 2 years in advance, we had a couple of down years, but otherwise, analysts tend to get this company right most of the time. I think that's a testament to the guidance the company gives, as well as the fact that it's a pretty clean business with a strong balance sheet, good financials, and is pretty easy to analyze. Okay, so now I've done all this, I've gotten other people's opinions. Then I like to turn to fund graphs in FastGraphs, the financial underlying numbers, again, on the idea that we make researching stocks, deeper and faster and easier with the tool. So I can go into fund graphs, which is our acronym for fundamentals analyzing numbers, and I can look at things like the balance sheet. And, first of all, and I can look at it in a per share basis, which I'm looking at here. And I can look at common equity or book value, which is probably not really that relevant for this company, but it is kind of gratifying to see that the company's book value has consistently increased. I like to look at debt, long-term, and then debt total. And I like to see that most of their debt is long-term, and keep in mind their levels are actually low. And then before I would leave this, I would go into their cash flow statement, and I would look at operating cash flow, and I would look at even free cash flow, and as I talk about this in the previous video that I showcased, to make sure that the company has, the cash flows to support, amortizing the debt as well as paying off of their dividends. So I would spend some time on that. I would go into the income statement, and we've already seen most of that on the FastGraphs, but I like to look at the revenues and see that the revenues have been consistently growing, other than we had a little hiccup in COVID, but that's been, obviously going past. And then if I look at, let me get rid of some of this data here because it's getting confusing. If I get out of the balance sheet here and go back into the income statement and look at revenues, quarterly revenues are beginning to increase, so I really like that. I then would go into our ratios graph. There's a lot of things I can learn here about a company. I can look at the current ratio and the quick ratio of the company. I think that's really important because I'm looking for, numbers above 1 on both of those metrics, and they're, substantially above 1. So I've got good liquidity in this company. That's, and that's actually been improving coming out of COVID quite a bit. Again, positive. Remember, this is a 100-year event that we've only seen about once. So I'm, going to look at that. But then I'm also going to go into some of these valuation rates. Well, before I do that, I also, again, would look at debt again, usually here in the ratios, trying to see the ratio of long-term debt, to total debt. Once again, the idea being is that I want to see that the company has, enough control of their debt that they're not going to get blindsided by getting a bunch of debt coming due at one time. That's the idea there. Then I like to go into the percentage graph. And what I'm really looking for here, this is gross and net profit margins. And what I see here is a very, very nice trend. Other than 2019, this company was consistently increasing their net margin. And, their gross margins were increasing by a little as well. But they have very, very strong margins, over 50% gross margins, and net margins in the double-digit range, and even got up in 2018 up to almost 20%. Okay, I can also look at that data quarterly, and I see that coming out of the COVID thing, the margins are beginning to improve again. So that's a good sign for me. But I can also look at other things, and I'm going quickly now because I don't want this video to be too long. But I'll look at things like returns on assets, returns on equity, returns on invested capital, and just try to see how healthy the overall business is. One thing I really like to do is I like to go into the in millions graph, and one area in the in millions graph that I really like to look at is share buybacks. Okay, and that's something I always go into. If I look at this company, you can see that they had very level amount of shares outstanding. They stayed at about 59, 58 million shares. But then after COVID, they did buy back some shares, okay? And this was during the time now when the stock got really undervalued. So I find that to be kind of a good sign, but that's kind of stabilized now. They haven't really been aggressively buying back stock. And now that the stock is overvalued, I'll be monitoring that to make sure they don't continue to do that going forward. The other thing I like to do when I'm in here and into the what we call the in millions graph, I like to look at the balance sheet and just look at their cash and cash equivalents. And the company, since COVID, has been building up cash, which again is another good sign. Looking at it from the yearly point of view, they've really had a massive increase in cash. That's giving them a lot of financial flexibility. So I'm very sanguine and positive about that. But the point is, this is how I've conducted my research and due diligence. Now, I'm going to just give you a sneak peek at the new version of Fast Graphs here. Just to show you that it is coming along, and a lot of it's working, but there's still some things that are broken. So I want to point that out to you. But, I'm going to go in here and I'm going to look at things like price to sales. That's another metric that I like to use. It'll be available on the new Fast Graphs. And this tells me that, the stock is very richly valued on a price to sales basis. So again, I wouldn't be doing due diligence on this company now, except for the fact that I am long the company and I've held on to it, and now I'm not concerned with the valuation at this point, but I'm aware of it, and I think that's an extremely important point to make. I'm aware that the stock now has become, fully valued again. I'm not panicked, but I'm aware of it. So, this is the new version of Fast Graphs that we'll be going into. You can see how quickly you can change metrics there. Just a little, kind of a subtle commercial for you. I can go through here and look at these metrics very quickly, and that's something I really look forward to sharing with y'all. But anyway, the bottom line is, this is how I conduct my research and due diligence. I believe it's critically important. The more you know, the better. Now, we're going to be launching, when we launch the new version of Fast Graphs, the Value You Academy. I've talked about that in the past. We're going to be launching some introductory videos here in the next couple of weeks. And then we're going to be going into all these kind of discussions about research and due diligence, how to read financial statements, how to evaluate a business, how to value a business. And I've got 2 academics that'll be joining me to help me. And they're going to take an academic look. And I'm going to look at a more, Fast Graph user look. And I think you're going to find that fascinating because there's a lot to come from Fast Graphs on our channel coming up. I appreciate you watching. I hope you enjoyed this concept on how I, do research, but I also hope you learned that, if you do comprehensive research and due diligence, even if you run into a problem, like we did with COVID, the market panics and the valuation gets real low, as long as the company's fundamentals are staying reasonably stable. And keep in mind, Snap-on had a minor drop in earnings through COVID, but they actually raised their dividend and their business actually did well and their cash flows actually did well. So, when you got that going for you, you end up getting these recoveries. So anyway, it's been Chuck Harwell saying thanks for watching. If you like this video, give me a like, give me a thumbs up, ring the bell. And if you haven't already, please subscribe to the channel. We got a lot of exciting things coming up with the Fast Graphs YouTube channel. Thanks for watching.